This is Kyrill with Centerfin, and this is our collective weekly for the week ending September 20th, 2024. As always, we like to highlight a handful of things that we thought were interesting during the week as it pertains to markets and investing. And this week, the big news that everybody was talking about was the Federal Reserve met and decided to cut interest rates for the first time in 2 years. We will discuss what they actually ended up doing and what we think that means for the markets going forward. And second, we wanted to discuss the resurgence of nuclear energy being led by technology companies. This is a trend that we think will continue for the next decade, if not longer, and we have discussed it in the past, and we wanted to highlight this news for you. So first, starting with the Federal Reserve. So the Federal Reserve was much anticipated to cut interest rates, as we discussed last week. This is the first cut in interest rates since they started hiking interest rates in 2022. The big question was, are they going to cut by 25 basis points, which is a quarter of 1%, or 50 basis points, which is a half of 1%. And the odds were about 50-50. The Federal Reserve actually cut by 50 basis points, or a half of 1%, bringing down their target rate from 5.25 to 5.5 to 4.75 to 5%. And so it was actually a surprise to some in the market, even though the betting odds were about 50-50. Most of the economists and academics were expecting a 25 basis point cut. It's somewhat unusual for the Federal Reserve to actually cut 50 basis points right when they start the cutting cycle. And so there were a lot of reactions, and we wanted to go through the kind of different takes that people had on this, on what this potentially means for kind of risk assets going forward. And one of the popular takes was that the Federal Reserve cutting 50 basis points means that the economy is actually doing worse than expected, and that they need to get ahead of it, and they need to ease financial conditions faster than they typically would. And a lot of the folks that have been in the camp that the recession is already here, or the recession is in the midst of starting, pointed to this as a data point that this is a sign that the Federal Reserve is admitting that the economy is weaker than they may have thought before. Some have even pointed to September 18th, the same date in 2007, when the Federal Reserve cut by 50 basis points to start a cutting cycle. In our mind, these two times, 7 and today in 2024, couldn't be more different. So we don't think that those are comparable. In our mind, the probably more plausible explanation for why they cut by 50 basis points instead of 25 basis points is because they were probably late to the party. So they probably should have started cutting in July by 25. And so instead they were catching up and cutting by 50 to get to where they should have been in the first place. Now, this view is supported by the fact that they also talked about the fact that they would only be cutting by another 25 basis points at each of the next meetings. And they basically projected another 25 bips at the next meeting and the following meeting before the end of the year. So a total of 1% of cuts for the year. The most interesting thing about this is that the Federal Reserve controls the overnight interest rate, which is really the rate at which banks lend to each other and at the rate at which the banks can borrow from the Federal Reserve. The interest rates that set the price of money effectively, which is why this is important to follow and understand what's going on. All of mortgage rates, consumer credit cards, interest rates on loans for commercial real estate developers, interest rate on loans for corporations are set off U.S. Treasuries. But the longer end of the U.S. Treasury curve, particularly the 10-year note, is not set by the Fed. So that's a market-driven rate. And that rate has actually come down by about 100 basis points since the second quarter of this year. And so effectively, the market has been projecting these cuts way ahead of the Fed announcement. However, it is still really important because the Federal Reserve first told us in December of last year that they were going to stop hiking interest rates and the next move was probably going to be lower. The market got ahead of itself. At the beginning of this year, we were pricing in 6 to 7 cuts for the year. And it looks like we're going to end up with 3 to 4 cuts for the year. But the important thing is that they actually took the action of cutting interest rates. Now, what is that going to mean for the economy and the stock market? It could mean that it spurs economic activity, right? So as people see mortgage rates coming down, they may decide to actually go and buy that house that they were holding off on while interest rates were higher. Corporations may finance a new project that they were not going to finance before because interest rates have come down a little bit. And generally speaking, economic activity could pick up. Now, that's good for the economy, but it does have a risk to it, which is inflation can also pick up based on this kind of increase in economic activity. And so this is something we have to watch because if inflation does start to pick up because economic activity has picked up, this could really cause a problem for the Fed going forward. But for now, the Fed took its first step. It was a big step. We don't think it means that the Fed is panicking in any way, but we do think it's significant in that we are heading lower with interest rates, which we probably should have been earlier this year. The second thing we wanted to discuss with you, which we think is really important, but you probably may not hear about it as much, is that this week we had a couple of big technology companies announcing partnerships or plans for nuclear energy deals to supply them with power for data centers. And so the big one was actually announced today. Microsoft announced that they're signing a 20-year deal with the closed down nuclear power plant in New York, the 3 Mile Island plant, that would allow for Constellation Energy, which is the company that owns the plant, to reopen the plant. And the rumored price of what Microsoft signed, it's not confirmed, was something to the tune of $800 million a year for 20 years. And this is a really big deal. We've long discussed that as we transition away from hydrocarbon energy into cleaner source of energy, nuclear needs to be a part of that solution. And we have not seen a ton of activity, at least in the US, as it pertains to nuclear power. And Microsoft taking this step and signing this agreement actually could the market and allow for other nuclear projects to be green-lighted because they can use the Microsoft deal as really a baseline for what the power would cost for how long. And these projects need a lot of financing, and they can now get financing where previously they couldn't really get financing because these are very expensive projects to start up. And so it's a pretty big deal. Oracle announced something earlier in the week where they were going to invest heavily into data centers and they were going to power them with small modular nuclear reactors, which is a relatively new data source. That is in line with what is happening with Microsoft. But I think both of these announcements speak to the fact that technology companies are going to have a big say in how our energy transition happens. And the reason for that is really, it relates back to artificial intelligence. As we've discussed before, artificial intelligence requires a ton of energy. And these data centers that need to power the servers that power this technology are not cheap to run. And these are really significant steps in the market. We've discussed before that nuclear power needs to be part of the kind of renewable and clean energy transition in this country. And we have not seen much until these announcements that happened this week. Keep an eye on the price of uranium because that's the input commodity, obviously, for nuclear reactors. It's something we've talked about in the past, and something we think will be a trend for the coming decades. That's all we have for you guys this week. As always, any questions or comments, please drop them below, and we will see you next week.